Hi guys, Harry Yotis here, professional trader for 20 years. Started my career way back in 2005 and still going strong in 2026. So in this video, I'd like to talk about Palantir, okay? Specifically a trade idea that I mentioned on X. I think it's good to go long Palantir, but how did I come up with that? And well, this video is here to tell you guys the process that I take. Briefly, it's a little bit more in depth than what you're going to see here, but it's basically a process of identifying stocks to trade and how I go about doing it. Okay, I'll try to be as brief as possible. Of course, you could always comment below if you have any questions during this video, and I will get to them as fast as I can. Okay, so I've identified Palantir as a stock that I like to trade. Okay, and here to the right of the screen, this is the chart of Palantir daily. Okay, we are currently on Saturday, the 28th of February. Okay, so the reason that I like it is because of the setup, the macro picture here. It's all identified here. The macro picture, the fundamentals, the technicals, and the structure. Okay, this is basically a quick 4-step formula on how to identify a trade. First, you have to have the macro environment. Okay, that means we're looking at the S&P 500 in general. That just kind of more fear from the previous video. The S&P in general. Is it bullish? Is the macro fine? Blah, 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 yada, yada. That's a video all on its own. And so we've assumed here, we've checked the box that the macro is positive. We should be entering long trades. Okay, it's very important to understand the direction of the market overall and the macro picture so that you have a tailwind on your back when going long or short. Okay, in this case, we're going long. Then the next step is the fundamentals. We have to identify stocks that are fundamentally strong. Okay, that is the next step. This is how you get into the micro. First is the macro, and then everything else here is the micro. Okay, so the fundamental analysis here for Palantir, well, you would have to go in and check it out, do an in-depth review of its financial statements and all that. However, because Palantir is a big stock, you're not trying to find a diamond in the rough. A lot of analysts have already studied it, and the fundamentals are very good for this stock. Okay, so you don't really have to go deep into the fundamentals when trading a big macro stock, but we'll go into it briefly to see how you would go about it if this wasn't a big stock and you wanted to identify a diamond in the rough. Okay, so for Palantir, the fundamentals are good, okay, and you should know why. Okay, so here we went into FinViz, a financial site, okay, and we plugged in Palantir. And the bottom here gives you a brief overview of the financials. Okay, the first thing that you should be looking at is profitability. Here we have gross margin. Can you guys see it? Maybe we can blow it up even more. It's a little bit too crazy. Here, I guess this is fine. So you have the gross margin of 82%. Gross margin is what a company makes, sales minus, let's say, cost of goods sold. Okay, beside not just operations. The operating profit is 31%, it's huge. But the gross profit, what it sells is product for, minus the cost of selling that product, is 82% it makes. This is huge, okay? And the profit margin here, the net after all expenses, it makes a 36% rate of return. This is astronomical. This is very, 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 very profitable. So we have the profitability on our side. Then we would look at the balance sheet to see if it's financially stable. Does this company have a lot of debt? Well, here we go. Okay, the quick ratio and the current ratio is what you should look at for short-term liquidity. This means that you take the short-term assets, the current ratio, the short-term assets divided by the short-term liabilities to see whether this company's short-term assets like cash, inventory, and accounts receivable could cover its short-term debts. Okay, so this ratio should be above 1. If it's 2, it's great. This means that it has no liquidity problems. It's not going to go bankrupt. It's assets, it's short-term assets, it's cash. It's plenty enough to cover its accounts payable, its accounts receivable. Its short-term debt is very, very it's covered a lot here. In fact, one might say this is too much cash. They have too many short-term assets. Maybe they could, maybe buy back more shares, give dividends, or just buy other companies, whatever. But this shows you the 7 is a huge liquidity position, okay? And the next one is the debt to equity and long-term debt to equity. Almost no debt. Okay, this is what you want to see. So you have a company that's earning 36% return net, very, very covered with cash, flush with cash, and in no danger of ever going bankrupt. Okay, so fundamentally speaking, this is a very, very solid company. The reason people hate it, people that want to short it and Michael Burry and all that, is because of these ratios right here. the valuation. Okay, look, it has a PE of 216 and a forward PE, which is what you should be looking at, 74. That's huge. Okay, that's like quote unquote overvalued. However, as traders, we don't give a crap about overvalued, okay? Because here in Palantir, for us, this is the opposite. You shouldn't look at it like Warren Buffett and Benjamin Graham, where the higher it is, the worse of a deal it is. No, okay? You should look at it in a completely different way, okay? When a stock is very, very high PE, it means that a lot of the institutions are buying it. It's very, very popular, in other words. Yes, it is overvalued, and one day there'll be a reckoning, but stocks can stay overvalued for months and years before they fall. Years, okay? So you want to be in a stock that the market wants, okay? So this is telling you right here that the overvaluation should be a complete non-issue for you when trading, because when we trade, we look forward 1, 2, 3 months, a quarter ahead. Okay, we don't look 3, 4, 5 years. Okay, that's investing. Trading, we want to make our moves in the 1 to 3 month period. Okay, it gives us plenty of time for our thesis to play out, and for the volatility of the stock to go in our favor. Okay, we want to pick volatile stocks because that's how they move fast. You make a lot of money. You want to pick popular stocks. So the fact that this is PE as high as it is, look at it. Don't look at it the PE ratio. Look at it as the popular ratio. Okay, the more popular a company is, the more the institutions like it, the more they're going to buy it. Yeah, price to sales is huge. Price to book is huge. All of this is huge, and yet it still went. This was huge. I mean, we had a PE ratio of 100 plus when the stock was trading at 60 here. It still went to 200. Okay, and here when it was trading at 60, the P ratio was over 80 or even astronomical. It still ripped to 200. Okay, and it's still a stock that everybody loves. So the only reason people hate this stock is because of overvaluation, which you should completely forget. Okay, as traders. Okay? So basically, this is a fundamentally strong stock, and you want to be in it, as we mentioned here. You should do more research. This is just a basic thing. I like to use Seeking Alpha to doing research. You should go into the financials. Okay, you should look at the revenues, how they're growing year after year, gross profit, all of the stuff that was mentioned here, the gross profit, as you see here, a gross profit of 82%. You'll see it in the, in the financial statements. Okay, and you should also compare it to its peers, how it's doing. It's without getting too much into it. There's more to it than that, but thank God that we're doing Palantir, so the fundamentals are already being taken care of by the institutions for you. It's a big stock. You could pretty much, without even looking, know that the fundamentals are strong. However, you should know why. Okay, that's why we go through a quick review of Palantir. It's super strong. You can tell right here from the profitability. You can tell right here from the balance sheet. Completely ignore valuation. In fact, you should be seeking high PE stocks because the market loves them. Okay, is going to pour a lot of money into them. So now we've identified number 1, positive. Number 2, good fundamentals. Now, that's how we've decided that we want to buy it because strong fundamentally driven stock with good macro tailwinds on our back. Now, this is where the technical picture comes in. This is where you look at technical analysis to see where to enter. Okay, and we've identified this stock here. I like these support and resistance zones here. 125 is huge support going back all the way to the beginning of 2025, February 2025. And look, it's held around there and it's bounced around there. So you can tell that this level is significant, okay, because it didn't just cut through it. It waited. It's down 35% from highs. Okay, so it's a big drop. Still quote unquote overvalued. We don't care about that. So to me, this is a great entry point, technically speaking, right at support after a big drop. So the technicals for me hit the picture. Perfect. Okay, this is why I want to be into it. Now, how do we play it? And that's where the structure comes in. I like to play it with options. So let's go to the options tree. Okay. Here, in case you guys are unfamiliar, this is an options tree. On the top here, we see April Palantir, April 17th. What is it? April 17th, about 46 days. This is May 15th, June. Okay, these are monthly expiries. You can get it goes by week if you want. You can get the April, the 10th. Here's all the expiries on top. The strike price is in the middle here. And we have the calls, the bid-ask spread of the calls, and the bid-ask spread of the puts. Okay, just so you guys are familiar with what we're seeing here. Now, which series should I pick? Should I pick April? Should I pick May? Should I pick any one of these? weeklies. Okay. Now this is where it takes a little bit of art as well. Okay. So we'll go back to our picture here. You know that as traders, at least I hope you guys know that I like to take 1 to 3 month time horizon. I want this game to play out for me. I don't want to go short term, 1, 2, 3 days. That's like noise. This is noise. You don't know where it's going to go between 126, 141. This is complete noise. Okay, we want to go for a big move here, a big move. Okay, that's where you make your money. So we picked a stock that is very volatile. We like that. We picked a stock that is fundamentally strong and good earnings, whatever. So now I'm looking at this earnings figure right here, which is going to be on May 11th. Okay, and I want to be able to take advantage of that because I think they blow out earnings like they have throughout every other time. Look, this is the earnings for the past, they came out in February. They beat by 8%. That's the bottom line. The top line, they beat by 5%. Look, everywhere, they keep beating. They beat the bottom line by 25%. Here, they keep beating, okay? So I like this company, and I want to take advantage of this earnings when they beat. Because here, when they beat, the sentiment was negative. So it went down with the market. But here, when they beat and the sentiment of the market is in your favor, it's going to go up much higher, okay? Look at this earnings. When it was going up here, this earnings beat by like 26%. It gapped up. So I think as the market turns around and goes higher, because we are positive on the macro as well, that I want to be in the game when this earnings hits. So I'm looking for a May expiry, okay? So we'll go back to the options. We're going to go into the May. This is the May. Now, which ones do we want to buy? This is where the art comes in. I want to get close to at the money. So I like to look at the, I'm building the structure here as we speak. Let's say the 145s, it's trading at like 136. So let's say the 145s to 75. $30 spread, okay? If we do that, it's going to cost us $7.75 or let's say around $8, okay? So the cost is $8 and this is our maximum profit. So we have 30. Let's write it down here, guys. Can't see. We have a maximum profit of 30. And if it costs us $8, you have to divide 30 by 8 and you get 3.7. That is not good, okay? I want at least a 4-to-1, preferably a 5-to-1 ratio for the calls. Okay, so 3.7 is not good enough for me. So this is not good. We have to wait. And the reason it wasn't good is because if you look, well, let's erase it for now. So 3.7 is not good enough for me. Okay, I don't like it. Okay, so we wait. 3.7 translates. Okay, and the reason was it went up. It was probably good when it was trading at 128, but now the price is 137. I don't know if you guys can see it. So hopefully it goes back down so we can get a better risk reward ratio. Okay. So and this is what you would put a good till cancel order in. Okay. So when it comes to this, it's not good. I have to wait until this goes lower. Okay. And usually when it goes lower and I really want the stock, I would also sell a 10 delta. Okay. Put, which is like a 10 delta means it's probably like a 10% chance of ever happening by May. So if I were to sell this put, it'll put it down to 6, okay? But I want this ratio. Remember, we're getting a 30 win here, and 6 is 5-to-1, okay? 5 would be better, would be 6-to-1. I want to get it down to at least 5 or 6-to-1 when I put the put, the 95 put. So if you see here, I would be buying the 45s, call here, selling the 75s. So I don't even want it to go to highs. I think it's going to do this in 3 months. So buy here, buy this date right here. And I'll be selling this 90 or 95 put, okay? And I want to get here. If I get the put without the put, I want a 5-to-1. With the put 4-to-1, a 5-to-1 risk reward ratio. With the put 6-to-1. Okay, I'm looking. much higher, because I'm taking a risk with the put I can get assigned. So if I get this put, I want this to go down to 4, okay? So I can get like, 30, a 30 win divided by 4 would be like a 7-to-1 risk reward ratio, okay? 7.5 to 1. So this is where the art comes in. You have to do your math. You have to see. And the reason I want it right at the money is because it's a greater chance for you to go profitable. You don't want to take these, buy this call. You don't want to buy the 80 call, okay, with it's cheaper or whatever, because the chances of that happening are very, very low. You want to be in the money, and you want to take a risk reward ratio where even if it goes between your two strikes, you still could make 3-to-1, 4-to-1, 2-to-1. So you want to have a 6-to-1, 7-to-1 risk with this. Without the put, this alone, I want it 5-to-1. 5-to-1 minimum. Even I know it says 4 would be the absolute minimum, but I want this 5-to-1. And I could get it if it goes here, undercuts it a bit. I might be able to get that for 5-to-1. Okay. And the put, when it goes down here, I won't be buying the 95. I can go down to 80 or 75 and get that, and get the equivalent price. So here, if you look at the 95 put, it's trading for 224 to 230. But if it goes down, if the price goes down, we can have the 80 put trade for that much, and we get a much better risk reward ratio. Okay, so right now I don't like it because the risk reward ratio is 3.75 to 1. We saw that before. Okay, if we kill this put, let's kill the put. The risk reward ratio 8. Okay, and we're making 30. That's not good enough for me. So I will not pull the trigger. It just makes no sense. But if it goes down, I will be pulling the trigger. If it ever goes down and retest this good support level, I hope, okay, then I'll be pulling the trigger here. Okay, you don't want to play the gambler's role and buy a way out of the money. You want to give it very, very close. Okay, here it's 137, so I picked the 145. But when it gets down here, okay, I might pick the 135, 165, or 170. Maybe give me a $35 total profit. Okay, and the put that I'm going to sell is way down here. Okay, it all depends on the situation. But if all things being equal, I want to have a risk reward ratio. Okay, I want to have a risk reward ratio of at least 5-to-1, and I want much higher, 7. Okay, much higher than that. So that's the structure. Okay, so let's recap. It's been a long video. Okay, first we go over the macro. It's positive, good. Then we go over the fundamentals. You want a strong, fundamentally driven stock. This is it. Okay, the technicals is when they come in after the trade has been identified before with the macro and the fundamentals of this particular stock. I know I want to get into it. Then I look at the technical picture to see when I enter. And after the technicals, then I have to start like digging and trying to find the structure that I like. We can go so much more deeper into this. Okay, we can get very, very technical. I won't run out that much time. But just to give you a picture of how the process would be like if you were to trade like professionally, take a professional approach, reduce your risk, increase your reward while playing it intelligently and not just shooting for the fences. Okay, so that's it, guys. If you like it, subscribe. Of course, leave a comment. There's way more to discuss, but I hope you guys get the gist of the process that is involved in picking a trade idea. It's not looking at charts. The charts are number 3. You got to go through 1, 2, 3, and then decide how to play it. Right? Later, guys. Bye.